You're listening to Talking Africa, the podcast that gets behind the news from the continent, brought to you by the Africa Report magazine. Head to theafricareport.com for more. My name is Nicholas Norbrook. Welcome to the podcast, a special edition this week, brought to you in conjunction with Invest Africa, the business and investment platform for the continent. The subject, coronavirus and the challenge for Africa, a webinar that went out on Thursday, 12th March. Do check the show notes for more details of upcoming Invest Africa webinars. We talk about the economic impact of coronavirus, spiking bond premiums, collapsing commodity prices, and the geopolitics of the virus in the context of the trade war between China and the US. Our panel, Arshed Abba, the Managing Director, EIU Canback South Africa, Vincent Rouget, who heads Control Risk's Political and Business Risk Analysis team for West Africa, and David Murrin, the historian and forecaster based in the UK. We start with Vincent Rouget to get a sense of the spread of the virus on the continent, and we recorded before the Kenyan and Ethiopian patients were reported on Friday.
It's probably worth saying to start that coronavirus COVID-19 in Africa so far has been relatively minimal in terms of actual cases. The cases have been few and far between, and overall the numbers are evolving every day. But so far we've recorded less than 100 cases, and only less than a dozen countries have actually recorded cases. It is perhaps not a cause for complete celebration, because I think it also says a lot about the lack of integration of Africa and African countries with globalization and international movements. But in this case, it has actually served the continent pretty well and helped probably delay the start of the transmission of the outbreak to some of these African countries. As we stand, South Africa is the sub-Saharan African country that has recorded the most cases of COVID-19. And we have seen a few other cases. The first one to report was Nigeria at the end of February, but so far the numbers have remained very low. And we've also seen in the last few days cases spreading mostly to Francophone West African countries, such as Senegal, Cameroon, Togo, DRC, Côte d'Ivoire, for example. Doing this list of countries, I think, also tells part of the story. The initial assumption when looking at Africa's exposure to the virus was largely based on a transmission scenario from China. And at the beginning, most of the studies that were made concerning the risk and the exposure of Africa really were looking at the amount of connections with China, the amount of trade relations with China. And I think it is perhaps worth noting that as the epidemic has spread to Europe, a lot of the new cases that we're seeing arrive on the continent are actually coming from European countries. The first few cases in Nigeria came from an Italian citizen that was traveling on business, and we've seen a number of cases being reported coming from French citizens or other European citizens as well. So the number of cases at the moment is still fairly limited, but I think this is an epidemic, obviously, where Africa is potentially lagging a bit behind, and the trend is likely to be worsening in the next few days, as the scenario that we've seen in Europe could repeat itself slightly with a slightly bit of delay. In the meantime, I think we're also seeing the operational disruption from that epidemic increase. It started pretty early on with suspensions of flights between China and African countries. Most of the airlines, with the notable exception of Ethiopian Airlines, suspended flights to China early on. We're now seeing perhaps a second step of the containment strategies of those countries, where they are increasingly resorting to quarantine measures, not only for visitors incoming from China, but also from some of the worst affected European countries. So the operational impact is still fairly limited, but is starting to be felt. And I think that's going to be the bulk of our conversation today. But obviously, the financial and economic impact is already being felt quite starkly. I'm in Nigeria this week, and the newspaper I opened on Monday morning was titled "Coronavirus Crashes Oil Price Halves Federal Government's Revenue." And I think Arshad and David will be well placed to comment on that economic impact. But it is really something that probably will be hitting Africa hardest, if not more so than the direct consequences of the outbreak.
Arshad, let's pick up exactly on that, because it has, a lot of economists were gathered together yesterday by Bloomberg, for example, and they said, the majority believe that in the third quarter of the year, we would probably see a devaluation. A lot of people are now quite keen to take their money out of the country. There's been a lot of hot money financing Nigerian government debt. This will have a significant impact, would you say?
Yeah, I mean, hi, Shard calling in from Johannesburg, South Africa. I think 2 points are important. Firstly, to talk about the Nigeria situation and then look at what is the longer term impact of lower oil prices globally. So I think from a Nigeria perspective, I think the plunge in oil prices will create significant pressure. I mean, we've seen downward pressure in Nigeria for a long time now. Central bank reserves have been down about 20% over the last 2 years. And possibly they could reach the $30 billion threshold set by the governor where they have to devalue their currency. So I think there will be pressure. I think the other point to note on Nigeria is that the government is largely dependent on oil revenue in terms of how they run the country, but the internal economy remains a bit more resilient. They've got other sectors that are quite important to them. So I think if you look at Nigeria compared to, for example, Angola, I think they may be a bit more resilient, but significantly impacted by the oil crisis. If we look at the larger oil crisis, and I think this is quite important to the discussion, I mean, how long and how sustainable is this oil crisis and effectively the price war between Russia and Saudi Arabia? And when we look at that, just having spoken to some of my colleagues, our sister company, the Economist Intelligence Unit, I believe that we will see some recovery or increase in oil price in the second half of the year. Just to contextualize that, if you look at the Saudi Arabia economy, right, essentially for them to be able to fund their fiscus in terms of their public service and investment plans, they need to recover oil at about $80 a barrel. So I think we're hoping that we will see that between Russia and Saudi Arabia, they'll be able to come to the table and come to some agreement. We forecast that will happen. If that does not happen, there will be some more significant impacts for African economies.
David, this does seem to be happening at a time when there isn't a US final arbiter on the markets. Someone I was speaking to a few days ago tried to sort of make the comparison with Mexico in the early 90s. But the difference was there was a Bill Clinton who was ready to step in. It doesn't look like there is anyone, especially if there's a sort of an oil price war going on between the Saudis and Russia. It doesn't look like there's any more adults in the room, if that's one way of putting it.
Okay, listening to the debate, I just want to go back to a few things to frame my answers, because I think people are failing to recognize some significant omissions. One is that the world was incredibly fragile at the beginning of this year. It wasn't euphoric, it wasn't strong, it wasn't robust. It has suffered from a 2-year hegemonic challenge by China to America, whose response was a trade war, which effectively bifurcated the world's trading system. And the exaggeration of numbers, the use of debt, the whole bubble dynamic that America created in stock markets was a defensive mechanism to being in decline. So this virus couldn't have come at a more dangerous place. My arguments as to really what was going on were commodity prices. And I predicted that oil would get to 27 prior to the virus because there was a demand crash coming, and this bifurcation was far more powerful than people realized. So we were always going to come here through a demand slump. What we call a war isn't a war. Basically, what's happened for any hydrocarbon economies, Algeria or Nigeria, and especially the ones that have kleptocracies, where they've stolen money from the people, therefore there's a huge margin of inefficiency, what they find themselves in is an unsustainable position. But if you're a swing producer like Saudi Arabia or Russia, the one option you've got when you get to the point where the price is unsustainable at current production is to increase production. And both Russia and Saudi would have come to that conclusion separately because it was their only survival mechanism in a demand slump. And what that means is any producer above their marginal prices is going to get wiped out. And this is not a spat. It's not something that can be mediated by some other person. It's a fundamental mechanism of the global economy that the demand slump has literally driven the demand away. And so they've compounded it with a supply side dynamic, but that supply side dynamic is to keep themselves alive. They will try and double their output at half the price in oil. And we will end up at 20. And when we get there, we're going to stay there. That's a bit that no one really understands. By the time you recover from the virus, it will not be a month or 2 months. It'll be 12 to 18 months. So they're pushing themselves into a hole in the race, and they're wiping out every producer with a higher cost base.
Now, it's not just oil that's going to suffer. Vincent, I mean, let's talk about the Democratic Republic of Congo. There's, for example, the big Chinese cobalt and copper producer, China Moly, which took over Freeport-McMoran's deposits a short while ago. They, of all the Chinese big companies active on the continent, they are perhaps slightly less connected to the government, slightly more exposed to market pressures. They will be struggling, and I imagine all the sort of supply networks plugged into their sort of ecosystem will be too. Can you speak to perhaps more broadly to the mining sector in the DRC and how they're responding? Are you there, Vincent? You may have muted yourself.
Absolutely. So I think there's an impact to consider across the mining sector in general, and in particular the bulk commodity exporters that are dependent on Chinese demand, really. So there's a pass through of this crisis through the price of those commodities, but also simply on the demand of Chinese importers for commodities such as copper and cobalt, as relates to DRC, but I would also extend this to bauxite, for example, for Guinea, Conakry. When it comes to DRC, I think you're looking at a picture that is actually fairly similar to Nigeria, where it is a country that was already battling economic difficulties prior to that crisis hitting. The mining sector has been affected by a revision of the mining code in 2018 that has depressed investment, followed by or around the same time was a lot of political uncertainty around the election, and generally a dependency on mining exports that gradually wound down forex reserves in Congo and led to a fairly precarious situation already before the start of the COVID-19 crisis. Forex reserves in Congo are well below $1 billion. They're a pretty fragile place. The IMF had stepped in to provide an emergency credit facility, but there was really a case of having to implement austerity in the context also of one of the major mines in the country being put under care and maintenance. So this crisis, I think, is only going to make things worse. And it is one of the countries as well where the political repercussions of this could be perhaps the most significant. In Nigeria, yes, the economy is struggling, but at least it is not an election year. It is not a year, aside from two governorship elections, where you have significant political pressures. In DRC, it is not an election year either. On the other hand, you do have a government led by President Tshisekedi since the start of 2019 that is still struggling to consolidate power, and that does need to be able to spend as a way of consolidating their authority and in a way ensuring continued stability. Now, they were already at risk of being unable to do so because of the weak state of the economy. And I think we're going to have to look closely as how much does the lower copper price and cobalt price and the contraction in demand from China affects the kind of export